Welcome to the Convergent November 2021 monthly market update. We will begin with a market recap. Following strong returns in October, the market rallied for much of November on the back of strong earnings and a continuously improving economic outlook. However, the strength was short-lived as the announcement of a new COVID variant sent investors fleeing to protection. With fears of another COVID shutdown gaining traction, markets across the globe sold off steeply. By the time November came to a close, the S&P 500 had given up all of its previous gains and finished the month down 0.83%. Falling in line with the relative strength shown throughout the initial COVID drop, the NASDAQ 100 outperformed all the other major indexes in November and closed plus 0.25%. With a larger concentration in cyclical stocks, the Dow Jones gave up most of its gains for the quarter in November and finished negative 3.73%. With the outlook of the response to the new variant still largely unknown, the struggles for cyclical COVID losers may continue in future months. After a strong run to begin the year, the Russell 2000 continues to struggle in the face of ongoing COVID shutdowns. With a focus on smaller companies, the Russell was hit the hardest by the initial COVID lockdowns and remains the most volatile major market index. Following a rocky month, the index closed down 4.28% in November. With fears the new variant could spread across the globe, the world index fell by 2.3%. After many months of strong returns and outperformance, commodities were hit especially hard by the variant announcement. Additionally, the significant drop in oil comes at the same time that our third-party research has estimated a peak in near-term inflation. If inflation has truly peaked, we could see commodity returns begin to struggle in future quarters. Despite a drop in long-term treasury yields, something that is typically a bullish sign for gold, the strengthening US dollar led to a fall in gold prices during the second half of the month. With the near-term peak in inflation, the US 10-year yield fell sharply alongside the correction in commodity prices. We will now move to the economic data portion, beginning with total claims. Total claims fell further in the month of November to just over 2.3 million. This level represents a massive drop from a prior year and is now in line with pre-pandemic levels. And while this drop is a positive sign for the economy overall, it's important to note that this data is reported on a few-week delay. And so as a result, with the new announcement of the new COVID variant, we could see some layoffs and subsequent a rise in total claims. And that concern has caused some selling in markets as people begin to fear what may come in the months ahead. New claims for unemployment came up slightly in November to back above 200,000. Looking back to November 2020, we saw a similar increase in claims as COVID cases increased during the winter months. This will be something to closely monitor if claims begin to increase for multiple weeks in a row this winter. Continuing claims, which come at a slight delay to initial claims, decreased marginally and now sit just above pre-pandemic levels. However, with new claims rising, continuing claims could see a consequential pickup in the next few weeks. And additionally, it's critical to note that while the claims have come down pretty significantly over the past year, many people that were initially receiving claims after the first spike in March of 2020 hit an expiration. And so the reason that the numbers may have been coming down were partially because people were returning to the workforce, but also just because those people hit an expiration on the benefits and thus went off of the reading, but really still remained unemployed. Despite a small improvement over the previous month, November's jobs report came in worse than expected and sent shockwaves through the equity markets. The unemployment rate fell slightly to 4.2%. This was marginally better than the expectation of 4.5% and provided some damper for the negative reaction to the other parts of the report. Concerningly, non-farm payrolls, or the new jobs added, came in at 210,000, which was much below the expectations of 550,000. This report initially caused a sell-off in the stock market and perpetuated fears of a weakening economy. Additionally, with inflation coming in at hotter levels than seen in recent years, and a potential for a new COVID shutdown on a horizon, this report could be just the beginning of a rough winter. As expected, year-over-year GDP came in around 5% for the third quarter. And while this is lower than the truly historic reading that we saw in Q2, year-over-year near 5% for GDP is a really good sign for the economy. However, it's also important to realize that largely supporting this number is the weak data coming out of the pandemic from Q3 of 2020. And so thus, just because the reading is higher than the previous year does not necessarily mean that the economy is back to pre-pandemic levels. Additionally, year-over-year CPI showed a sizable increase of 5.34% over the previous year. With the combination of supply chain bottlenecks and numerous direct-to-consumer stimulus payments, the expectation for inflation to rise throughout 2021 came as no surprise. While the jump in inflation has been kept under control for now, many consumers have been left wondering just how far it'll go. Based on our third-party research, we actually expect near-term inflation to peak in Q4 of 2021 before stair-stepping lower in the first few quarters of 2022. And we've kind of seen this come to fruition here in the last few weeks with the recent drop in inflation-linked equities. Another concerning data point has been the ongoing crash in consumer sentiment. After the announcement of the new COVID variant, consumer sentiment fell past the March 2020 lows to the lowest level in nearly 10 years. And as we've discussed in previous market updates, this is really concerning because of the growing disconnect we're seeing between the equity markets and consumer sentiment. And one of the major risks that could occur from this is a small event could cause a really major reaction in the markets and lead to a lot of losses. And so we saw this on the day after Thanksgiving when the new COVID variant was announced. And with many market participants actually taking that day off away from the markets that day, we saw the markets have a huge move, a huge reaction in response to the announcement. Pending home sales rose slightly in October, but fell on a year-over-year basis. This reading comes as home prices continue to skyrocket higher across the country. However, with inflation beginning to show signs of a near-term peak, we could begin to see a deceleration in home prices. After spiking higher in October, the market fell in November with the announcement of the new COVID variant and renewed concerns of an economic shutdown. And while we have seen relatively strong market returns in recent months, concerns do persist with year-over-year economic data beginning to slow, inflation continuing to accelerate, and the further disconnect between the market and consumer sentiment with the emergence of the new variant. So while market participants have enjoyed this massive bullish run over the last year and a half, many economic and political concerns lie in the months ahead. For this reason, we have begun shifting our convergent investment philosophy to an all-weather approach that is designed to perform well in all market conditions. We hope that you have enjoyed getting this deeper look into our investment research and look forward to providing it to you each month moving forward. Thank you from the entire Convergent team.